every single year, in year 4, I do the same thing. In year 5, I do the same thing. So at the end of year 5, I've now kind of run my vault dry, right? And I'm really considering my vault as a reservoir. I want my vault to be the reservoir of all my capital. I've run my reservoir dry. Right now, I'm in Utah, and right now it's snowing outside right now. The snow is
Wow.
going to melt and it's going to fill up the reservoirs. That's
Mhm.
exactly what I have to do on my equity mill now. At the end of year 3, I've got $663,000 in policy loans, but here's the crazy part. I'm going to go back to the growth asset on my game, which is my real estate. It's now valued at 4.2 million. All I did is hold the assets. I have 2.3 million in equity because my tenants pay down my debt a little bit every single year, and the increase in the value of money, or not the value, but the amount of money drove up the price of my real estate. Yeah?
Correct. I'm tracking so far.
Okay, but man, here we go. This is the
Can we
funnest
just
part.
go back? So you said in year 1, and you're assuming year 1 you have $650,000 of cash value.
Yeah.
So is that the assumption? Obviously, most people watching this year 1, they wouldn't be there. Are you assuming year 1, or are you assuming year 1 of retirement?
Year 1 of retirement. Great
Okay,
question.
so this
So
is actually 10 years
10
in.
years in. Yep,
Okay,
yep,
10
yep.
years in,
Great.
you have $650,000 of cash value. You've built up. Okay, so okay, I'm tracking so far.
So for the first 10 years, all I did is I said, look, I'm never going to get what I want in Wall Street, especially if my definition of success is retiring in 10 years or less.
Yep.
I shifted all of my savings, all of my focus into putting money in life insurance. I used life insurance to be down payments. In this example, in the book, it was 14 properties that we actually owned.
Yep.
So 14 properties, those properties amortized, they appreciated. I did equity harvest a little bit out of them in year 3 and 4. I put all of that in new life insurance. I just want to get as much money in my life insurance
Right.
policies as possible.
So in year 10, you got 1.3 million of equity,
Mhm.
a total portfolio of 3.4,
3.4
and
million.
3.4, you have a $2.7 million death benefit. You're taking $120,000 policy loans for um tax tax-free cash flow, and then the properties are just, is it fair to say they're just self-funding? Like, you're not necessarily taking cash flow from the properties, but you're not necessarily needing money because of the am I saying that right? Like,
You're saying it
the
100% right.
assumption is no income, but the income, it is creating extra cash flow, but that cash flow is going to, you know, just from a risk management standpoint, you're becoming less risky because you're creating some buffer.
That's it right there. Like,
Okay,
it didn't need to cash flow at all. I just want the way I become wealthy is owning the assets and letting time work for me.
I
So
see.
whether
Okay,
or not it creates cash flow, yes, I want it because that makes it easier to own it. But in this example, I'm not even touching the cash flow. I didn't even factor it into the equation.
I see. Okay, I'm tracking so far. Yep.
Okay, now we're getting to the funnest part of all. Now we're at the end of year 5. We had a great 5-year run, but this is lifetime retirement income. This isn't, hey, 5 years and I'm back to work, right? So now I'm going to go back to my growth engine of my machine. Now, Caleb, you're probably seeing some similarities here, okay? A lot of this research was justified and backed up with Dr. Wade Pfau's research on the volatility buffer strategy, but rather than using the market, I'm using real estate.
Hmm.
Okay. And I'm using the vault to not be a buffer of risk inside of the market. I'm using the vault for income, but my growth asset is my real estate. We've already proved that. And so now I'm going to go back to my real estate portfolio valued at 4.25 million. I have $1.9 million in current debt. So I'm just going to go back to any bank in the world and say, look, I want to re-amortize my mortgages. I want to now take $700,000 of cash out refi. I'll re-amortize as a block or individually one by one. And I'm going to push my debt from 1.9 million up to 2.6 million. Okay. I'm going
I'm
to take the
tracking.
$700,000. I've got $633,000 of policy loans. I'm just going to pay my policy loans back. Now, in this case, I've got a little bit of extra cash, so I'm going to assume I put that in my policy. So now, at the end of 5 years, I've harvested the equity from my real estate portfolio. I've paid back my policy loans. I've put a little bit of extra cash from the cash out refi into my cash value. That wasn't necessary, but I did it in this example. So now in year 6, I have $825,000 of policy loans. My real estate portfolio is still valued at what it's at, and all I want to do is run another 5-year game. right? So now if I want to increase my income because of inflation, now if I take $825,000 and I divide it by 5, I can give myself a 37% increase and raise my income from 120 to 165. And if I draw 165, just like we did for 5 years straight, at the end of 5 years, I'll draw my policy down and I'll have to go back to my real estate portfolio, my equity mill, harvest the equity, replenish my policy loans, and repeat the process.
Ryan, can I ask a question? I don't want to kill momentum here, but just how are we funding the policy throughout the years, at least paying the minimum premium? Is that coming from active cash flow? Is that coming from how are we doing that? Or is part of the 120, is that the idea is like we're going to take portion of that and pay the policy base premium?
Yeah, great question. Now, my recommendation is you should always pay your base premium. You should always put money in, but just make it as simple as possible. We didn't factor in any new premiums going into the policy after year 10. It was just premium offset, and the growth of the
I
policy
see.
was
Okay.
funding the
Okay.
policy.
That's a fair assumption from a standpoint, the assumption could be it only could get better if there's obviously more money being injected. So
It only
I
get
just wanted
better.
to make sure that we weren't double counting your that. So that answers my question. Yeah. No, I'm tracking so far. So you're using the volatility buffer, but instead of your money being in Wall Street, you're creating real estate portfolio and you're using life insurance and real estate versus life insurance and a stock portfolio.
Yeah. Let me go back to how I see the game of money. And I hope this is divisive. And I'm not saying it to be divisive, I'm saying it to be very direct. There are two games of money, and they're going on in parallel in our economy right now. And you, whoever's listening or watching this right now, you get to choose which game you play in. And the first game of money is the game of money I started in. I call it the dependency game, right? And in the dependency economy, I trade my time. And really, my time is my life. I trade my time for money. I save what little money I can into, mutual funds, 401ks, whatever. And that side, in the dependency economy, everything in the economy is now working against me.